Hello and welcome to episode 24. This week we reveal who won the battle between Apple and Netflix. We take a look at our portfolios and we battle two defensive stocks against each other. Without further delay, let's get underway. Every week we invest £25 into each portfolio. One portfolio where you select the stocks, one that tracks the market, and one that generates income to pay to you. We'll then invest an extra £1 into each portfolio for every 100 subscribers we get. Apple faced off against Netflix in last week's stocks picked by AI. And it looks like if you want a healthy portfolio, it's a case of having an apple a day, because the winner was Apple.
3, 2, 1, go.
Last week was a pretty good week for us in the markets. The Battle Royale and the Income Generator both up 1.2% and critically beating the benchmark, which was up only 0.7%. Either way, all in green, so very pleased with that. However, this week, a completely different story. Everything in the red, negatives again. It has been tumultuous in the markets, as I mentioned, and the Battle Royale falling by a whopping minus 0.8%. The benchmark performing slightly better with only 0.5% down. Hopefully, this coming week is going to be better for everyone. Here were the biggest movers in the Battle Royale last week. Spotify Technology up a whopping 13.6% and Reddit not far behind with 12.9%. That's ahead of its earnings, so it'll be interesting to see what happens next week. Tesla, the biggest dropper, with minus 10.6%, although as you can see it's gone up 86.8% over the year, so not too worried about that one. A new thing I want to show you is what's happening next week. As I mentioned, Reddit has an earnings release and there are a few ex-dividend dates. However, dividends are not a big part of our Battle Royale portfolio, so nothing too exciting over there. Just ignore the bird construction. I don't know how that slipped on there. I think that must have been on a watch list previously, so ignore it. Thanks. Taking a quick look at the total value of all of the holdings now, Tesla's still top of the tree. And I just wanted to highlight as well the new addition from 2 weeks ago, 3i Group. It had a lovely week for us, plus 2.5% up already, although I think we put it in too late. So in total, 1.8 overall since we've held it. And that's added 34 pence to our £25 investment. Further down, where it's not looking so healthily, still holding up the rear, B&M, Renew Holdings, Black Rifle Coffee, Tate & Lyle, AMD, those are all of our worst performers. And of course, at the front, Tesla, On the Beach, Spotify, Nichols. Spotify had a great rally to take up third spot, and Reddit has slipped into fifth after its fantastic run last week. We now hold 22 holdings, 22 stocks and companies, and I'm very pleased to say that we're maintaining the positive to negative ratio. We've now got 12 stocks in the green and 10 in the red. So we're better investors than we are not. Turning now to take a look at the Income Generator and how much money it's paying us in dividends. The annual figure at the moment is £16.44. That's up from £15.72 last week. I do find it amazing how quickly that number grows, which is fantastic. We passed the December payout and got our £2.43. So now we can add that to March's projection of £2.93. And what we're going to pay the first lucky subscriber on our first 6-month jackpot, if we can call it that, is £5.36. So how's everything looking overall and in total from a full portfolio perspective? Well, we've now added £550 into each of our 3 portfolios, and as of last week they were all in the green, all ticking along very nicely. Income Generator, the lowest performer at just over 4%, the benchmark a very solid 6%, and the Battle Royale very happily outperforming them all with 10% increase. This week, it still remains the case that they're all in the green, which is great, no major drops. The Income Generator, still the lowest with a 4% total return. The benchmark has not dropped to a total return of 5.8%, but I'm showing you the Simply Wall Street calculation, which is slightly more accurate because it doesn't take into account, which is what Trading 212 did, which is what I was originally getting the figures from. I had another small investment in the same benchmark index, and it was including that calculation. So it's a more accurate figure. of 5.8% return, not the 6.35%. And very happy to say the Battle Royale is smashing that with 10.7 in total. So we are doing well. And in this bull market, I'm going to be bold and say, wow, we are amazing investors. Well done, us.
3, 2, 1, fight.
I think it's pretty safe to say it's been tumultuous in global politics recently. In the US, it's craziness and tariffs. In the UK, it's stagflation and extra runways. Before that, it was DeepSeek throwing the markets into turmoil. So that got me thinking it's time to look at defensive stocks. So first things first, what is a defensive stock? I turned to my first point of information in all things, Investopedia, and it was a great source of help, as it always is, and it says a defensive stock is a stock that provides consistent dividends and stable earnings regardless of the state of the overall stock market. When looking at these sorts of companies, we should be looking at whether its revenue is stable, if it has dividends and how stable they are, what sort of market position it has, and how defensible is that market position. Does it have a good moat? These sorts of stocks should protect you in any economic climate where the growth stocks are struggling. This is when these stocks are meant to come in and protect your portfolio. But remember, you do want some growth potential, so you don't want to look at a completely stagnant company. And when looking at the dividend, make sure you check the yield, and this is so that you can make sure that the sustainability of the dividend payments is strong. I looked at quite a few companies that might be considered defensive, and it was really difficult because there's so many good ones. I looked in the UK and the US, and some of the ones I looked at included GSK, which is a fantastic UK company, Philip Morris, which is also has done incredibly well over a long period, Unilever, that's been in the press quite a lot lately, lots happening, Procter & Gamble, everybody knows them for a reason, and their stats look quite good, and good old British American Tobacco, BATS, if only because the stock ticker is such a great one. But of those two, of all of those, I've narrowed it down to two, and I liked the look of Procter & Gamble and BATS the most. According to Simply Wall Street, Procter & Gamble is trading at 25.7% below its estimate of fair value, and BATS 49%, which is whopping. However, with the defensive stock, you're probably not too worried about whether it's good value because you're not expecting a huge amount of growth necessarily. You're more considering the stable revenue and the dividend payments. Both have high levels of debt, although not normally great. I think that's the way these companies tend to be leveraged, and their actual revenue is so high that I'm not particularly worried about it. They both pay a dividend. P&G do a 2.4%, and BATS has this crazy 7% dividend yield. Sorry, dividend, but it's not well covered by earnings, so that is something to consider. However, both very good companies, very tempting, so let's investigate them a little bit further. Okay, so let's take a look at and compare their high-level metrics. Here they are side by side, and if you take a look at their graphs over the last 3 years, although BATS does have the slight little dip, they're relatively stable. They're not shooting up, they're not shooting down, they are just nice and defensive. Okay, looking at their stats, P&G, massive company, 395 billion. I think massive is an understatement because, of course, British American Tobacco is huge with 73 billion, which is massive, but it looks tiny in comparison. The PE ratio of P&G is massive. That is surprisingly high at 36.34 times. And British American Tobacco, they've had a little bit of a rough time. They're at minus 5.4. Their earnings per share is also negative at 6.4, whereas P&G is positive 6.3. What BATS does have going for it is it's got a massive dividend yield, 7%, and P&G 2.4%. Both have high volumes, high revenues, and low betas, which is of course the volatility, which is what we're after. So very closely matched. You think it's going to come down to whether we want high dividends or whether we want the slightly more expensive, robustish, if we can call it that, company. Once again, it's going to be tight this week. So there you have it. Who do you think we should invest in? I'd love to hear your thoughts in the comments. But from my perspective, I would suggest we invest in... Thank you so much for watching, everybody. I hope you have a fantastic week and that just everything goes well for you all.
Goodbye.